Welcome to this week's edition of Macro and Flows from Orestes Capital for the week ending on June 26, 2026. We're Elena and Marcus.
And this week certainly tested the nerves of anyone managing a portfolio. We observed massive trading volumes, intense sector rotations, and, well, some highly complex plumbing events across the market.
Yeah, intense is probably an understatement. I mean, we saw semiconductors swing 30% in just 3 days.
Exactly. Billions of dollars were flushed through index rebalancing, and predictably, the consensus across the street immediately rushed to declare the technology boom completely dead.
Right. The prevailing narrative shifted to panic almost overnight. But if you actually look under the hood, the structural engine of the economy hasn't stalled at all. So our mission for this deep dive is to cut through that noise.
Precisely. For you listening, watching these massive swings could easily induce whiplash. Our objective today is to separate the underlying structural economic signals from the tactical market mechanics that are, frankly, just pushing paper around.
And to do that, we rely heavily on our proprietary modeling, specifically the OCM-PCA model. It allows us to view the macroeconomic foundation completely independent of the daily trading chaos.
We should probably establish exactly what that baseline looks like before we dissect the specific capital flows we saw this week.
I agree. Let's start with the OCM regime map. We use a framework called Principal Component Analysis, or PCA. For you listening, the simplest way to understand PCA is to think of it as an advanced engine diagnostic tool for the financial system.
Right, it's a diagnostic tool.
Exactly. When you're driving a car, the windshield presents you with endless daily noise. Weather, passing cars, bumps in the road. In the financial markets, that windshield noise is the daily headlines, the panic on financial television, and the minute-by-minute stock price fluctuations.
And the PCA model ignores that windshield entirely. It plugs directly into the engine block to identify the core pistons that are actually driving market returns over time.
So, Elena, when we look at the diagnostic readout from our proprietary modeling this week, what is the engine actually telling us?
Well, the 5-year structural horizon sits in a remarkably healthy state. Specifically, the model registers a normal growth state with a positive 0.76 z-score.
And a positive 0.76 is highly constructive.
Exactly. It also indicates a reflation bias with a positive 0.29 z-score. For context, a positive z-score means we're operating comfortably above the historical baseline.
Right, so a positive 0.76 means the long-term structural engine of the economy is running highly efficiently. It's characterized by steady growth and manageable inflation.
Yes, and if you consider that 5-year reflation view as a heavy freight train, it's currently moving steadily down the tracks with immense forward momentum and solid structural integrity.
And I want to push back on this a bit because the nuance is critical here. The data gets complicated when we run our robustness checks across different time horizons, doesn't it?
It does. While the 5-year train is moving well, when we shorten our analytical window to the 3-year horizon, our modeling shows a sharp crossover into what we classify as a Goldilocks regime.
A Goldilocks regime.
Yeah.
So not too hot, not too cold.
Right. It's a state where growth is stable but actively cooling, and inflation is no longer accelerating. We're observing a significant divergence in our first principal component, PC1, which tracks global growth.
And the short-term momentum there is dragging heavily.
Yeah.
The numbers on that drag are stark. I mean, the weekly impulse flow printed a highly negative -1.03.
Which is a massive sequential drop.
It really is. We're seeing this pressured by heavy unwinds in emerging markets, including broad indices like the Kospi aggressive selling in copper and a rapid rotation out of cyclical stocks.
To put that momentum shift into perspective, our 4-week z-score for PC1 is now at negative 0.90. Our internal triage model officially flags this level as stretched negative.
Stretched negative. Meanwhile, our other main components are virtually silent, right?
Exactly. PC2, which tracks rates and reflation, and PC3, which measures economic surprises, are currently completely muted.
So there are no significant data shocks occurring. We aren't seeing massive beats or misses in payrolls or inflation prints. The market is trading entirely on gross pricing dynamics.
Which brings us back to your freight train analogy, Marcus. The recent 3-year Goldilocks shift simply means the conductor has taken their foot off the accelerator, allowing the train to coast.
Right, the engine has not failed. The train is certainly not derailing. It is merely experiencing cyclical fatigue.
Precisely. And if you contrast our steady structural view against the prevailing narrative across the street, which spent the entire week panicking over daily weakness in the tech sector, the disconnect is obvious.
The fundamentals remain intact, but the rate of acceleration has paused. So because that growth momentum is dropping, we have to investigate exactly who is selling and who is buying right now.
We do. We need to determine if this selling is driven by fundamental investors reacting to a shifting economic reality or by structural market participants who are just reacting to mathematical price trends.
And the best place to start there is with systematic traders, specifically commodity trading advisors, or CTAs.
I think we need to translate the concept of CTAs for our listeners because market intelligence reports discuss them constantly without explaining their mandate.
Absolutely. Systematic traders are essentially algorithmic surfers. They do not care about the temperature of the water, nor do they care about the fundamental health of the ocean beneath them.
They certainly do not read earnings reports.
No, not at all. They only care about the direction and momentum of the wave. They are programmed to buy when prices cross specific upward moving averages and to sell when prices begin to drop below those thresholds.
And right now, market intelligence shows that these CTAs remain significantly long on global equities. Their specific allocations this week are incredibly revealing about how these algorithms function.
What were the specific flow numbers there?
Well, market intelligence indicates CTAs heavily purchased China equity futures, executing $7.1 billion in buy orders, and they paired that with $4.7 billion in China 10-year bonds.
And let's be clear, they aren't buying these because they suddenly believe in a structural turnaround in the Chinese consumer.
Exactly. They are buying them strictly because those assets hit a technical breakout level, which triggered a mathematical buy signal. In contrast, they added to their short positions in United States front-end rates and executed heavy selling in Brent crude and silver.
So these are purely trend-following capital allocations. But traditional fundamental asset managers are behaving very differently.
Very differently. The consensus across the street shows that these fundamental investors, the mutual funds and pension managers who actually care about valuations and earnings, are rotating aggressively out of the NASDAQ.
Right. They're taking capital away from the mega cap technology space, which has become incredibly crowded, and they're reallocating it into small and mid cap indices.
We're seeing massive inflows specifically into the Russell 2000 and mid cap indices, as well as the Dow Jones. But we can't ignore the plumbing flush at the end of the week, which heavily distorted all of these numbers.
Yeah, the market plumbing was under immense pressure on Friday. The trading volumes were staggering. This was driven by the combination of the Russell Index annual reconstitution and a phenomenon known as quad witching.
Right, quad witching, where index futures, options, and stock options all expire simultaneously.
Exactly. But the Russell rebalance is where the real distortion happens, primarily through custom in-kind baskets, or CIBs.
We should definitely explain the mechanics of a CIB, because it explains so much of the tape volatility we saw.
It does. Think of CIBs as a massive plumbing flush for the financial system. When an index like the Russell reconstitutes, it drops certain companies and adds others.
Right, it's scheduled maintenance.
Exactly. And ETF managers tracking that index are legally forced to mechanically swap out vast amounts of specific stocks to match the new index weights.
But if they simply sold the old stocks on the open market and bought the new ones, they would incur massive trading costs and trigger capital gains taxes for their investors.
Precisely. So instead of selling, they use a CIB to swap the underlying shares directly with the market maker. They hand a basket of the old stocks to a dealer, and the dealer hands them a basket of the new index components.
Because of this mechanical plumbing flush, no cash is actually leaving the system?
None. But you see huge artificial ETF inflows into mid, small, and value funds, alongside massive outflows from certain growth vehicles, such as the ARK funds.
And to the untrained eye watching the daily ticker, this looks like intense panic selling or sudden manic euphoria.
When in reality, it is nothing more than structural housekeeping by index providers. So once we isolate those automated plumbing flows, we can step back and examine the real-world macroeconomic data.
Right, the data that is actually impacting everyday liquidity and steering the rotations made by those fundamental asset managers. Let's look at the interest rate shifts.
This was a major driver this week.
It was. This week, the 10-year Treasury yield eased, falling 8 basis points to close at 4.37%.
And for you managing a portfolio or a household balance sheet, the 10-year yield is the ultimate benchmark for the cost of capital.
It dictates everything from corporate debt issuance like when a company prices a BB or CCC bond to the rate on a 30-year fixed mortgage.
Exactly. So when that yield drops by 8 basis points, it directly lowers corporate borrowing costs. It acts as a direct tailwind for consumer pockets.
And the bond market is currently pricing in the fact that our PC1 growth momentum indicator is slowing, which is why those yields are easing. We saw this macro shift play out directly in sector performance.
Right. Housing was a massive beneficiary.
Yes. Because of the drop in yields, the housing and homebuilder sector significantly outperformed the broader market. The math is straightforward. Lower yields mean cheaper mortgages, which translates to sustained demand for homebuilders.
But on the flip side, we saw WTI crude oil fall by 9%. And Elena, I have to ask, if our PC3 indicator, which measures economic surprise, is registering as completely flat, why did oil just plummet 9%?
It's a great question, Marcus. The answer lies in the broadening out trade. Capital is not leaving the financial system. It is migrating within it.
So it's moving out of stretched, highly levered trades.
Exactly. It's rotating away from trades that rely on massive economic acceleration and into defensive, high-quality sectors that benefit from easing yields. Oil drops in a Goldilocks environment because the market projects that a cooling economy will demand slightly less industrial energy.
Right. The flat PC3 simply tells us the economy is exactly where we thought it was. Cooling, but not collapsing.
Precisely. The asset movements we are seeing across energy and housing are simply valuations recalibrating as the cost of borrowing shifts.
But the capital migration isn't frictionless. I mean, to understand the severe whipsaw volatility we witnessed in the semiconductor space this week, we have to look beyond the companies themselves and examine the plumbing.
Specifically, how Wall Street options dealers manage risk through dealer gamma.
Right. Dealer gamma sounds incredibly complex, but we can demystify it by thinking of Wall Street options dealers as the shock absorbers of the stock market.
That's the perfect analogy. When a dealer sells an option to an investor, they take on risk. To remain market neutral and protect their own balance sheet, they constantly buy and sell the underlying stock to hedge that risk.
And when dealer gamma is positive, the mathematics of their hedging requirements force them to buy the stock when it dips and sell it when it rallies.
Which provides massive liquidity to the market and gives asset prices a very smooth ride.
Exactly. The problem occurs when gamma turns negative, which is exactly what happened in the technology sector this week.
When gamma is negative, those shock absorbers break. The mathematical hedging requirements invert completely.
So dealers are suddenly forced to sell the stock when the market drops and buy it when the market rises.
Right. They stop being shock absorbers and turn into amplifiers. They speed up the decline, exhaust liquidity, and exacerbate volatility in both directions.
And that amplification was highly evident in hedge fund positioning. Market intelligence shows that United States long-short gross leverage fell to a one-year low of 201.4%.
Furthermore, net leverage fell to 51.9%. We should clarify those terms. For context, gross leverage measures the total market footprint of a fund, both their long and short positions combined.
And net leverage measures their directional bias, how exposed they actually are to the market going up.
Right. Both of those metrics falling so sharply indicates that hedge funds are rapidly taking risk off the table, unwinding their borrowing, and shrinking their overall footprint.
We saw this deleveraging focused heavily on the Magnificent Seven mega-cap technology stocks. According to the consensus across the street, these specific equities were net sold for the fifth consecutive week.
The selling pushed their gross and net exposures to near three-year lows. The hedge funds are structurally reducing their reliance on the handful of tech stocks that drove the market for the past 18 months.
And the semiconductor sector bore the absolute brunt of this structural deleveraging, largely because of that negative dealer gamma amplifying the hedge fund selling.
We witnessed extreme whipsaw volatility there. Daily moves across major semiconductor names, printing positive 7%, followed by negative 13%, and then positive 16%.
It's incredible. And it wasn't driven by fundamental news about chip manufacturing. It was driven by a combination of aggressive profit-taking, deleveraging, and negative gamma hedging.
Though it is worth noting that there were idiosyncratic industry stories underneath the chaos. Memory chips, specifically DRAM, actually drew massive capital inflows, even as the broader semiconductor indices were aggressively sold.
I think we need to point out a crucial detail here regarding overall market health. Despite the technology lag dragging the S&P 500 down 2% for the week, the selling has been highly orderly.
It really has. We are not observing a systemic panic or a rush for the exits.
Not at all. Credit spreads remain tight. You look at CLO and CMBS markets, everything is functioning normally. The banking sector is quiet. It is purely a mathematical unwinding of leverage.
And the proof that the market remains fundamentally healthy is what happened in healthcare. While technology contracted, healthcare, specifically the biotech sector, which finished up 8%, saw massive M&A-driven inflows.
Yeah, the $10.9 billion buyout in the biotech space provided a significant anchor for the entire sector.
Exactly. When an acquiring company deploys $10.9 billion in cash for a buyout, that money doesn't just disappear.
Right. It goes straight into the brokerage accounts of the target company's shareholders.
And those fundamental asset managers we discussed earlier suddenly have billions in fresh cash, which they then reinvest directly back into other companies within the biotech sector.
Which creates a massive floor under the asset class. The market is fundamentally healthy under the surface. It is simply experiencing a heavy structural rotation.
So the synthesis of our OCM factor trends, the mechanical index plumbing, the options gamma, and the macroeconomic data leads us to the most critical part of our analysis.
Identifying the pain trade and detailing our key takeaways.
Right. Our goal is to provide clear, contrarian analysis that you can apply to your portfolio right now. Let's identify exactly where the crowd is currently wrong.
The prevailing narrative in the financial media is singularly fixated on the mega-cap technology sell-off. They are aggressively broadcasting that the unwinding of leverage in semiconductors represents a cyclical top for the entire market.
They are projecting an imminent economic contraction, but our proprietary modeling explicitly disagrees with that narrative.
It absolutely does.
Yeah.
The OCM PCA model flags the PC1 global growth momentum as stretched negative.
And in quantitative terms, when a momentum factor is stretched this far to the downside in an otherwise normal structural environment, remember our positive 0.76 z-score on the 5-year view, the risk asymmetry shifts dramatically.
Right. The pain trade is the scenario that will cause the maximum amount of financial pain to the majority of consensus positioning. Right now, the pain trade is getting caught shorting growth.
Because the indicator is stretched so far negative, the mechanics of mean reversion suggest a high statistical probability of a sharp near-term rally higher.
If you are heavily shorting the market, expecting a systemic collapse, a violent snapback rally is the primary risk to your portfolio. The algorithms and the hedge funds have pushed the pendulum way too far to one side.
Therefore, we can outline specific, actionable takeaways for your positioning. First, stay long on broad equities.
Yeah, in the normal regime identified by our structural modeling, historical forward 4-week base rates are highly constructive.
Historically, this specific macro state yields a positive 0.77% return for the MSCI World Index over the subsequent 4 weeks. The math simply does not support abandoning equities here.
Second, regarding your credit allocations, you should stay positioned for high-yield tightening.
Yes, historically in this specific macro regime, high-yield spreads tighten by a positive 0.39 basis points.
Which means the premium that investors demand to hold riskier corporate debt over safe treasuries is shrinking. It indicates structural confidence in corporate balance sheets.
Whether you are looking at BB or CCC issuances, the fundamental backdrop supports holding credit.
You should also position your fixed income portfolios for curve steepening, as the short end of the 2-year yield curve reacts to the cooling momentum.
Third, on the commodity front, avoid heavy exposure to energy. Our historical data shows that Brent crude acts as a persistent drag in this exact PCA environment because marginal demand for industrial inputs falls during a Goldilocks transition.
And you should also avoid chasing highly leveraged cyclical assets until that negative PC1 momentum normalizes. Instead, use gold as a strong portfolio anchor.
Gold acts as an excellent non-yielding safe haven that exhibits a highly positive base rate expectation as real rates and borrowing costs fall in our current regime.
So to summarize the actual mechanics of what we witnessed this week, the structural growth engine is absolutely fine. The algorithmic surfers are blindly following tactical trends.
The index funds are fleshing out their plumbing through custom-in-kind baskets.
And the options dealers are simply amplifying the daily volatility because their shock absorbers broke due to negative gamma. But beneath all of that noise, capital is just migrating to quality and defensive yields.
Which leaves us with a critical strategic question. We have established that our structural 5-year reflation view is currently clashing with a 3-year cooling Goldilocks reality. The momentum has slowed.
So I'll leave you with this final thesis to mull over as you adjust your allocations in the days ahead. As the mega-cap technology trade mechanically unwinds its accumulated leverage, are we approaching a tipping point?
It's the multi-billion-dollar question.
It is. Is the broadening out trade, the migration of capital into mid-caps, biotech, and housing, transitioning from being a mere tactical hedge to becoming the absolute only engine of growth left in the market?
Because if capital entirely stops flowing back into the semiconductor space after this deleveraging cycle and solely relies on defensive yield rotations, the indices will look fundamentally different by year-end.
It is the defining mechanical question for the quarter ahead. See you next week, wherever the flows take us.